Welcome everyone, and I thought it would be a good time to talk about UK inflation because we just got the numbers out a few days ago and it was pretty shocking and it's had some fairly big market impacts. So I think it's not just the numbers itself, I think it's about what it tells us about the UK economy, which is worrying. So let's just quickly go through that. And I should also say that we're going to be doing a YouTube live next week. So if you do have questions and you don't have your question answered today, you can still join us next week and we can hopefully answer your question then. And as always, if you're one of our supporters on YouTube, we'll push you to the front of the queue. If you do a super chat, we'll push you to the front of the queue for the questions today. And I'll also go through the numbers just to kind of frame the conversation, because I always think it's good to anchor things in data because that's how I roll. Okay, so let me just go through some of that right now. Right, here we are. Yep. Very good. Make myself a little bit bigger. There we go. Right, so to start with, this is the data that we've just seen, right? So on the face of it, it looks pretty good because if you look at the CPI number, it's come down to 8.7. That's well below the peak we reached about 6 months ago of 11.1. Now we've been over 8% for just over a year now. This is the 12th successive month where we've been above 8%. But look, it's not double digits anymore, and it looks like we've got disinflation, which is when the rate of inflation is falling. That doesn't mean prices are falling, of course. What it means is that the rate of increase has slowed down. So pretty cold comfort for people living in the UK because, a slower rate of increase of prices isn't great, and wages are still well below that rate of price growth. So negative real wage growth is still a problem. Now, that's the headline number, that's what they call it, and usually people kind of ignore that, professional economists, but also central banks, because that's got two very volatile components in it. And the reason why we don't like volatile components is if you're trying to steer the ship of monetary policy, in other words, set interest rates, it's kind of like a supertanker because it's got a really long lag between changing the controls and the ship moving. So what you don't want is to have a very volatile number, so you're constantly steering for something volatile, when what you really want is to know, what's the steady core rate of inflation. So what we do is we strip out the two most volatile components, which is food and energy. And what you end up with, and in the UK it's also tobacco, and what you end up with is core inflation. And that's what central banks tend to look at to steer the monetary policy ship. And here you can see that what's worrying is that core inflation actually accelerated. It's not going down, it's not disinflation, this is increasing. And that's pretty worrying. So on the face of it, not too bad. But when you dig into the core, that's increasing. And that's very worrying. Now, if you look at food inflation, this is the one we stripped out. Yes, you can see it's very volatile. 2% is a dashed red line here. That's the Bank of England's target. And you can see food inflation is currently 19%. So I know that that's not part of core, but in terms of the poorest people in society, food makes up a bigger part of their consumption basket. So for the poorest people, this is a real problem. And we'll talk again about this in a moment, but I think the problem with inflation right now is it's disproportionately hitting a very specific part of society which can probably least afford to be hit right now. Now, if we look at core inflation and we compare it with the rest of the world, so here's that 6.8% again that we just saw. But notice how if we compare it with the other countries like Germany, the US, Italy, all the other rich countries, Japan is creeping upwards. But remember, Japan's problem hasn't been inflation in the past, it's been a lack of inflation. And they've been kind of flirting with deflation, you can see, for some time. So for them, not such a problem. But if you compare us with the US, for example, core inflation is coming down. Canada as well, core inflation coming down. Italy's still coming up. Germany seems to have stabilized, but we seem to be accelerating upwards. So that is a worry. And we also have the highest level of core inflation for amongst all of the largest developed economies. So that is worrying when you compare us with other countries. And if we compare the headline rate of inflation as well, you can see that disinflationary effect here. Inflation's fallen from the peak. But again, we're above the EU average, which is 8.1%. We're above Germany, we're above France, and we're above a comparable measure of inflation for the US, which is at 3.8%. So that's the problem. The UK seems to be suffering from rising core inflation, higher inflation than the rest of the developed markets, and also core inflation when you strip out energy, which remember has been what the Bank of England says they can't control, of course, because of the Ukraine war and Russia's invasion of Ukraine. Well, it's not just about energy anymore, and it's not just about food anymore. It's about core inflation. Now, the problem as well, I think, is, and here's a tweet from Ed Conway from Sky News, and what he's talking about here is not the inflation rate per se, it's about the medicine to cure it. And in this case, the medicine may be worse than the actual disease itself, the inflation, because the minute we got that really high core inflation print, what happened is that the very short end of the curve, the very short-term bond yields in the UK shot upwards because those price in expectations of monetary policy. Why does that matter? Well, if you have a mortgage, it's usually priced, not exactly, but off that rate, that bank rate. So that is a worry. And if it's, what are we pricing in here? If we zoom in on that graph, what we're expecting, or at least the markets are now expecting, is that by the end of this year, by December 2023, according to the overnight index swap market, we're going to be at roughly 5.35%. So in other words, 3 more rate hikes to go, when many people were thinking, we're kind of done now. We're not going to do any more interest rate hikes. We'll be like many other central banks, which are approaching the end of their cycle. But with an inflation print like this one, that's looking unlikely. So it is looking likely that we're going to get more interest rate increases, that there's going to be a problem for the economy if that happens, because remember that the housing market in the UK, the people who have mortgages in that market are going to suffer a lot because of these rising interest rates. It's going to be good for savers, not so good for borrowers. So the medicine itself, I think, is the problem. So what does this tell us about the UK? Well, it's telling us that inflation's stickier here. There's also an interesting article in the FT today. Let me just share this with you. I'll just switch to me and then I'll switch back to that. Okay. Yeah, let me just show you the yield curve as well, because that's kind of interesting and also slightly worrying. So this is the yield curve in the UK. And the green line at the top here is the latest yield curve. Let me just refresh this so you see the latest. Yeah, it hasn't changed. Okay, so look at the 6-month part of the curve. Now that's at over 5%, 5.1% roughly. Compare that with where it was a week ago. It was 4.8, and a month ago it was 4.8. So a huge increase in that short-term interest rate, pricing in expectations about what the about what the Bank of England's going to do. And it's a parallel shift across the whole yield curve. So even in the belly of the curve here, 5 to 10 years, you can see that that's moved up hugely from something like a week ago, 3.8 to 4.3. Now in the fixed income market, that's cataclysmic. That's a huge shift upwards. So remember, prices going up, yields going up is prices going down in the bond market. So what we're seeing here is bond markets selling off like crazy in the UK. Yield curve up, prices down. And this is kind of crisis period. People have said that this move, this very rapid move in the bond yield curve, is very similar to the move we saw after the crazy budget from Truss and Kwarteng. So particularly at the short end of the curve. So make no mistake, bond prices are telling us that there's a big problem. Okay. And the other interesting article, let me just show you this quickly. Oh, I've moved. The other interesting article is this one with my favourite person, Andrew Bailey, figuring large here. Here we go. Actually, I'm warming to Andrew Bailey. Here he is. Talking about the UK being the sick man of Europe. And if we scoot down, you can see this really nice graph. A lot of the stuff we've already discussed. But this is the interesting graph. The inflation rate of goods and services with little import intensity. In other words, a lot of what the bank's been saying is about things which we import which require currency. Because if we import something from abroad, we have to convert currency. So if it's fuel, like gas, natural gas, we have to pay for it in dollars. So we have to convert from pounds to dollars. And the argument was that all of these things which we're importing suffered from the pound being weak, and so that made them more expensive. There was a kind of pass-through effect. But what we can see here is if we look at the goods and services without import intensity, so things which don't depend on imports like natural gas, energy, these also are now starting to spike upwards in terms of inflation. So the contribution of these to inflation are now much bigger. So that suggests that it's not just about exogenous factors, things like energy prices, things like things which a Bank of England essentially can't control. This is about things like wages. And if it is wage price spiral, which Bailey has now admitted is causing inflation in the UK, we do have a wage price spiral. You just have to look at the news headlines to see strike after strike with wage agreements being negotiated. It's pretty clear that we do have a wage price spiral. And people are saying that this looks a little bit like the 1970s. So this is the spike we've had in headline inflation so far. And it's kind of like the foothills of inflation in 1971. There's an interesting little anecdote here about mobile phone charges. So the Bank of England apparently has admitted also that it just didn't see the stickiness of inflation this time around. So they didn't realise it would be so sticky. And things like mobile phone charges actually had inflation-linked contracts. So remember, that's what caused inflation in the 70s to stay high and to go higher. A lot of wages were explicitly linked to the rate of inflation. It was just automatically built into your employment contract. But this time around, it's mobile phones which have got this inflation linkage built into the contracts. So yeah, I think that's a worrying comparison if it is like the 70s, because you only have to look to see what happened next to see why that could be a problem. You know, inflation reaching 25%. It's not going to happen this time around. I doubt it very much. But the worry is that we're now seeing stagflation, and if interest rates increase a lot, then effectively we're going to have a break on growth, and that's going to be bad for everybody. Increase in unemployment is what we'll probably see, and a period of weak growth which could last for some time. And this comes just after the Bank of England upgraded its growth forecast because of the fall in energy prices. So that is worrying. Right, so that's it from me. So I'll hand it over to you if you want to ask any questions. And I might summon the dog while we wait for those, if we haven't got any. Because Teddy is a bit of a star on the live streams. So let me just see if I can summon the dog. The noise which summons him are the treats. Let's see if it works. Ted? Teddy? Ted? He's probably in the office with Laura, so I think she'll probably free him in a minute. But yeah, if you do have a question, if you do a super chat, we'll push you to the front of the queue. If you're one of our members, oh, here he comes. If you're one of our supporters on YouTube also, we'll push your question to the front of the queue. Ted? Teddy? Yeah, here he comes. I thought you were going to let me down there for a minute, mate. People only watch because of you. There we go. He's not that keen on these. He prefers the biltong, which Laura keeps in her office. But yeah, I'm not going to give you biltong. This one. Yes. Very good. Anyway, yeah, so if you do have any questions, please do super chat, because obviously I've got to feed Teddy and I've got to give him treats. Yeah, treats. He heard the word again. Here we go. Oh, you won't be sick, will you? No. Very good. Brilliant. Okay, so, no, you can't have the box. I can't believe you're sniffing the box. Oh, Teddy. Okay, that's it. No more. Oh, he's got the biltong. You can hear the biltong downstairs. Very good. So I've lost my dog now. Yeah, so any questions, and yeah, super chat would be good, or if you're one of our members, I'll someone says you give your dog biltong. Wow. Yeah, he loves it. So, he'll do anything for biltong. So somebody's saying, guessing linkers are still a buy. Yes. So I just calculated the uplift on my linkers, because some of you may be aware I bought an inflation-linked bond mid-March, and already, if I look at the RPI index, RPI inflation is what linkers are linked to in the UK, and the uplift since March is already over 3%. So I've already made 3% on that, and I'm expecting I'll earn about 8% when you annualise the return until the bond matures sometime next year. So yeah, it's looking pretty good. And I think linkers might still be something to consider. But what I did was not to buy an inflation-linked fund, but to buy an inflation-linked bond, a single one. So I opened an account with Interactive Investor. I couldn't do it on Vanguard, obviously, because they don't have single bonds. And I recorded the whole thing. Anyway, there's part of that recordings on YouTube, if you want to see about my inflation-linked bond purchase. And for members, I made a longer version, which has all of the details with the spreadsheet and the whole thing. So, yeah. But I'm very happy with that inflation-linked bond purchase. In fact, I kind of wish I bought more now. But it's always that way, isn't it? You don't know. But what I thought was that the Bank of England was a little bit too optimistic about the rate at which inflation would fall, particularly for RPI. And so that's why I bought it. But it looks like that was a good idea in retrospect. Let's see what else we've got. Any questions? Okay, so I'll scoot up to the top of the list here. As I say, we're doing a live stream next week as well. So if I don't answer your question today, don't worry. Jordan Warrington says, are we all going to die? Certainly. We don't know when. And then Eddie Ward said, probably. And Jordan Warrington replied, good to know. Always helps to be prepared. See, that's why I love these YouTube live sessions. It's the humour. Okay. Somebody's saying Nvidia adding 250 billion in market cap today. Fraud, ASF, lulls. Yeah, well, I think the valuation now, the price to earnings multiple is now over 200. I think it was over 250 from memory. So, is that fundamentally justified? Unlikely. Is it a frenzy? Is it a kind of euphoric move? Almost certainly. But everybody's buying into the kind of AI boom, So, that's the latest blockchain instantiation of euphoria. So somebody says this is Nick. Nick says, can you see Bank of England raising target inflation rates from 2 to 4% if inflation sticks? I think that's unlikely because, I think the problem that the Bank of England faces right now is credibility. If you look at what the inflation swap market is pricing in terms of inflation from this point onwards, other central banks have a much lower future rate of inflation priced into markets. The Bank of England's the expectation is that the UK will have a higher rate of inflation, which is a roundabout way of saying that it can't control inflation. They've let it get out of control, and also that they can't control it. At least that's the market perception. So credibility for a central bank is absolutely critical, because if people don't believe the bank can control inflation, then people will start living their lives assuming inflation is going to stay high. They'll ask for those wage increases. Companies will carry on putting up their prices. So if that happens, it becomes a self-fulfilling prophecy. So central bank credibility is probably the most important thing of all. It's hard to quantify. The swaps market is usually how you kind of look at it, but that is worrying. So if the Bank of England suddenly turns around and saying, oh, this 2% target, we didn't really mean that. We meant 4%. Well, markets are not going to like that. People won't like it. Suddenly living with double the rate of inflation is completely different. And it looks as if they're just trying to get out of meeting their obligation, which is to get inflation to 2%. So yeah, I think it's unlikely they're going to move their target rate. That's very unlikely. So as Eddie Ward says, Bank of England don't seem to be able to control much. Yeah, that is the worry, that kind of sentiment. Why are we not able to buy 3-month treasury bills like Americans can? Well, yeah, the thing is, if you did buy them as a UK investor, Eddie, they'd be very volatile, so you'd have to currency hedge it. And if you currency hedge, the cost of the currency hedge depends on the interest rate differential between the UK and the US. So whatever rate you'd be earning in the US, you'd actually be paying away for the currency swap. Or you could just take the currency volatility. But if you buy 3-month treasuries, say, T-bills, then effectively, if you add on top of that sterling versus the dollar volatility, what you'll get is a tiny little movement in the bond fund day to day, or even month to month. And on top of that, you'll be adding the currency volatility for sterling versus the dollar, which is roughly 12%, even more at the moment. So effectively, what you'd be buying is dollar, sterling versus the dollar. You'd be buying the currency. So that's why, if you don't currency hedge, you're buying the currency. If you do currency hedge, you pay away the interest rate differential anyway. So yeah, all I'd say is it's probably best to buy short-term government bonds in the UK. And it was interesting today on PensionCraft's chat, and a member added a new money market fund, which I hadn't come across, from Royal London. So now we have a list of about 4 of them, all very cheap, all less than 0.15% fee. CSH2 is one which I've discussed in the past, but there are 3 others on that list. It's a spreadsheet that we have, which has the cheapest funds in every category. And I think we have 5 money market funds now listed. But if you want to split your money and don't want to have it all in one money market fund, just in case, then you can do that. But look, in the UK, you're going to be earning more. So if you put money into a money market fund in the UK, effectively you'll be buying short-dated gilts, and the rate you earn is now over 4%. So, that's the benefit. If you are a saver, now you're earning more. Still negative in real terms, but still not bad for a very low-risk investment. And at the moment, of course, the US short-term bond markets freaked out about the debt ceiling. So, yeah, I'm not sure I'd want exposure there right now. That could get ugly very quickly, as we're about a week away from the X date. depending on your estimate, but the X date is when the money runs out and a default could happen. So that is worrying. Very worrying. But, you know, we don't have a debt ceiling in the UK, thank goodness, so not a worry for us directly. JW says, a lot of this food price driven. Well, remember the core inflation, which is accelerating upwards, and it's currently 6.8%, higher than the rest of the OECD. That doesn't include food. But yeah, food inflation is very high and very unpleasant. Yeah, the point I was making about mortgage rates was that a lot of the people in the UK now own their house outright. There's no mortgage, and it's usually older people who are in that situation. Younger families and poorer people who aren't so well off, kind of the same thing in many cases, do have mortgages. So the pain is going to be disproportionately felt by younger people and poorer people. Older people who are savers and who also have more capital anyway are going to see this as a good thing, right? So they're going to like this. So this is going to increase that generational gap as well. If you're a young person in the UK now, it's a terrible situation. Very high inflation, negative real wage growth. You're looking to see your parents' lifestyle at your age and probably thinking, look, I thought that each generation was better. I'd expect to have an equal quality of life as my parents. And yet that's not what we're seeing. We're seeing real wage growth falling for the last decade. So, you know, for the next generation, for my kids, you know, I'd like to see their quality of life being better than mine, but that's not what we're seeing. It's a kind of step backwards, which is worrying. So that's what I meant about the inequality. I mentioned it earlier. Let's just see if we've got still no YouTube supporter questions, still no super chats, but please do super chat if you have a question. We'd appreciate it. Right. So somebody's saying that how raising rates will reduce input cost, food price rises. I have no idea. And you're right, it doesn't. Oh, Cold Tea. That's one of our members. It was the same guy. So he's talking about T23, which is a UK gilt, which is about to mature. So it's, you know, if you want to lock in that 6-month rate, you could buy a government bond, a single government bond, or if you want to get inflation protection, you could buy a linker. A lot of the pension crafters have been asking questions about buying single bonds, which is why I did it myself, because I thought I'd understand it better, and I certainly do now. Oh, interesting comment from JW, who says commercial property leases and rent are also largely index linked. So a lot of these things we're going to find out are index linked. Wages aren't directly, so at least this time around it won't be so bad as it was in the 70s. But certain things will go up. And if commercial property prices increase, then that's going to reduce margins for the companies that inhabit those pieces of commercial property. So that's not good in terms of growth. And corporate profits, of course. Where do you think rates will peak? This is from Eddie. I think, certainly the swaps market is expecting it's going to be at the end of this year, and it's going to be at 5.3%. So 3 more hikes to go. And if core inflation carries on increasing, I think that's a real risk. We could see a couple more rate hikes, which is terrible if you have to fix a mortgage or you're a borrower. Yeah, so let's just hope that doesn't happen. Okay, good question. Peter says, why do brokers make it so difficult to buy either individual bonds to hold to maturity or individual inflation-linked bonds? My experience, the bonds weren't so bad, right? So for the bonds, for the gilts, I could just find it, click on buy, and I was done. It all seemed to be working. For the linker, I had to call them, right? So I had to make a phone call, which is very 70s. And then when they book the trade, it doesn't uplift the value of the bond. So it looks as if there's like, I don't know. It's quite an old bond. It was quite seasoned. So it had a big uplift of about 50%. So it looked like 50% of the value of the bond was kind of missing. So I was panicking trying to figure this out. And then I realized that's what it was. So now it looks like there's a huge gap in my portfolio with money missing. But in fact, it's just the way they record the trade on Interactive Investor. So I just think that everybody buys stocks, but very few people in the UK buy bonds. I think that's going to change. But currently, the back-end systems are just not geared up for it. Vanguard doesn't even let you do it. You can't buy single bonds, single stocks, probably for reasons of simplicity. And thank you for the super chat. That's really kind. And I'll get the name of the person who did it. Amir Ketobchi. Thank you very much, Amir. Amir, I should say. That means bookmaker in Farsi, interestingly. But yeah, I think, brokers are just making it hard. I don't think they deliberately make it hard. I think it's just not many people interested in doing it compared to stocks, for example. But now that everybody's kind of moving off meme stocks and Apple and Nvidia, I think people will move more towards fixed income now that the yields are more attractive. And once they figure out that with a single bond, you just hold it to maturity, and you don't care what happens to the price. You just know what you're going to get exactly. You know exactly the cash flows to. You know when they'll be paid. You know exactly how much you'll be paid. You know the yield you'll have if you hold to maturity. With inflation-linked bonds, of course, you don't. You have to guess what inflation will be between now and the maturity date, which I did, and it looked pretty attractive. So, yeah, it looks on target for that 8% yield for my inflation-linked bond. Yeah, but for linkers, yeah, you're just making a stab in the dark, really, as to what inflation will be. But for nominal government bonds, you know exactly what you're going to get. So I think people will latch on to that. Also, you don't pay capital gains on UK gilts and UK corporate bonds and UK linkers. So that itself is also very attractive if you're holding them outside an ISA or a SIP. No capital gain. So yeah, lots of interesting things there. So Amir's question, he said, oh, does he have a question? Wanted to support you with Super Chat. Thank you. Merci, Amir. Also, what should UK investors do if the US defaults and the portfolio drops 20 to 30%? Well, where can you hide if we do get a US default? I think the worry is that it would cause kind of contagion, right? So if people are worried about US bonds, even though we don't have a debt ceiling here in the UK, I think it could go either way. I think people could shun UK bonds because they're worried about the US, even though we're fine, right? It's not a problem. My guess would be that other developed market government bonds would actually rally in response. What's weird is in 2011, what happened when they really went to the wire with the default, and then the US got downgraded. When the US did get downgraded, what rallied? Yeah, it was treasuries because people were scared. Stocks sold off, but treasuries rallied, which is kind of weird. This time around, I don't think that's going to happen. I think treasuries would sell off. Particularly what we've seen so far is the sell-off was around the maturity date, where the maturity date was close to the X date. So this is now like a week away. So if you look at the US yield curve, the yield for those bonds is much higher because people don't want to buy them. So my guess would be that money market funds in the UK would be a fairly good place to hide if there was a US default. Cash, of course, always a fairly safe bet, but of course we have to worry about inflation at the moment. But if you're seeing a 20% fall in stock markets, then I'd be happy to park money in cash if that was the case. But I think money market funds would be okay in the UK. Gold probably would get a big bid. So, that's the usual things that would provide protection. But stocks, clearly, not so good. That's where you'd see the big falls. And a US market which is already overpriced, and which, is still treating it as if it's not happening. We're not really seeing any kind of pricing in of a US default at all. That's kind of weird. And if we look at US spreads on the high yield market, again, everything's fine. So I think a lot of complacency in the equity market, in the corporate bond market in the US. They're just assuming this is going to get solved. So let's just hope it does. Next question's from Pixel Monkey, also a super chat. Thank you, Pixel Monkey. He says, I recently purchased CSH2 and it's gone down 0.06%. Is that normal? No. I only bought it today, to be fair, just making sure. Can I get advice if I join? We don't provide advice, but we do provide education, Pixel Monkey. So, people will discuss the SH2 and the reasons behind the move. Let's have a look at it. I'm surprised it's moved that much. Oh, and look, I've got a list of UK money market funds here. So CSH2 and the price. Let's zoom in. Move me over here. Here we go. So this is CSH2. Now this pays out at a rate which is equal to or very close to the SONIA rate, the Sterling Overnight Index Average. In fact, many of these funds do. So if we look at the Royal London one, which I mentioned, and the Legal and General one, if we compare these, notice how they all give you a fairly similar rate of return. These are all accumulation funds, so the capital gain it's hardly significant, it's all about income. When the SONIA rate is 0, it's kind of flat. When the SONIA rate increases, as it has recently, the gradient increases because the slope is the interest rate. And currently that's increasing if you annualize it at a rate of just over 4%. And after recent changes, probably a bit more. But you can see they all give you a fairly similar exposure. So if we zoom in on those recently, I can't really see much of a fall there. I mean, let's just zoom in a bit more here, right at the end. Is there a 0.6% fall? Yeah, maybe. But you can see if there was a fall, it was fairly short-lived. I mean, it could just be a pricing error. But you can see that they're very low volatility anyway. It could just be a pricing glitch. So I wouldn't panic, put it that way. Back to me. Here we go. So yeah, Pixel Monkey, don't panic. And if you do want to join us, then what you get is the ability to chat to the rest of us. And a lot of us own CSH2. So we'll also be worried if you put a chat like that on there, and we'll all check with you. But that's why people have been asking about it on the chat channel at UBS. What am I talking about? At PensionCraft. The reason is that people are worried that if they put too much money into CSH2 and it goes down, what's going to happen to their capital? So they've been splitting it amongst other equivalent funds. So that's the kind of thing which we talk to each other about. Cole says, sounds like the bid offer spread to me. It actually went up by 0.2% today. Yeah, that sounds right. So if you buy it, because it's an ETF, there will be a difference between the buy and sell price. That's the bid offer spread. And what Cole T says is right. You'll have bought it at the higher price, and what you'll see quoted is usually the mid-market price, which will probably be a little bit less than what you bought it as. So, give it a week or two, you'll see that upward gradient start to affect your investment. Yeah, that's it. Let's just see if there are any other questions, and then we'll probably draw things to a close. What else have we got? Yeah, somebody's saying fee is free, but there's always bid offer spread. Yeah. Pixel Monkey says, yes, haha, I'm going to join. It's a great community. Thank you. And thank you, Cold Tea, for the comment. Thank you. Fern says, like in Argentina, like in Lebanon, citizens in the UK should buy brick and mortar because the currency will plummet. I'm not convinced, it's that bad. The UK is kind of undervalued. The UK currency is undervalued. Let's have a quick look at sterling, because it did take a bit of a hit. Quite a big hit. Okay. So here we go. Have to be careful what you say on a YouTube live. So let's zoom in on that. So this is sterling versus the dollar since 1970. Clearly not a pretty picture. Let's zoom in on now. Let's just zoom in on that recent bit. So of course it's the really recent changes that we're interested in. Yeah, let's get, 5 days will do. So what have we got? We've got a downward move of, now what you'd usually expect, if interest rates in the UK went up relative to other countries like the US, you'd expect the currency to strengthen. But not in this case, because that's kind of behind what the FT was saying about us being the sick man of Europe. If there's economic weakness, if there's GDP growth weakness expected, and that goes part and parcel with the sticky inflation and weak growth, then the currency won't strengthen. It's not just about the short end of the curve, which doesn't really get affected by growth expectations. It's also about the belly of the curve and the long end of the curve that matters. But let's just draw the percentage change move. So if we go back a couple of days before this weak inflation print, what have we got? We just draw this percentage change. Yeah, so about minus 0.8, which is big for the FX market, certainly. Let's just zoom out again. Yeah, not good. So currency has weakened as a result, no question. But it was on a kind of downward trend anyway, I guess. But this didn't help. So yeah, not good for sterling. But, should we go out and buy bricks and mortar? Well, what you're talking about is commercial real estate. And is that going to be in a good state in the UK? A house price is going to be in a good state in the UK with interest rates increasing? I don't think so. We could be talking about a problem in the property market in the UK, commercial and residential, if interest rates have to be so much higher for so much longer. So I'm not convinced that that's the right way to do it, or at least the right way to play it. So back to your questions. And let's do a couple more, then we'll draw to a close. What's the main component of inflation in the UK? Is it energy? Not anymore. So fortunately, I've got an R script which breaks it down, and that's what I opened with actually. Let me just share that with you. Whoops, this one. Yeah, so these are the components of CPI inflation. So these add up to that headline number, which is 8.7. And these are the individual contributions to the 8.7% from various prices in the consumption basket for the UK. Now, what used to be the case is that housing and household services was the biggest contribution because energy prices feed into this breakdown via that component. Because if you pay a gas bill or if you pay an electricity bill, it goes into this slice, the housing and household services. But notice that's no longer the biggest component. The biggest component is now food and now non-alcoholic beverages. So food inflation is now the biggest component. Not only that, but if you strip out food and energy, core is still going up. That was the big worry. So that's how we kind of opened this. Maybe you weren't here for the beginning. That is worrying. What else have we got? Colty says, I reckon some of the dollar's strength is perversely a risk-off trade. Yeah, maybe. If it's against all the other currencies, I guess that's true. And then Pixel Monkey says, but surprised it's not the franc. Yeah, I mean the Swiss franc, you'd expect to be a safe haven. Okay, interesting question. Omelette mackerel tempura. Not sure about that culinary combo. Even I might struggle to eat that. Which country would you escape to if the UK economy gets destroyed? Good question. Where would be safest? I mean, I do like Switzerland. Switzerland's a lovely country. I'd have to learn Swiss German. Or possibly French. My French would have to improve. Yeah, maybe Switzerland would be a good place to go to. But I don't think we're quite there yet. I think it's just going to be a period of weakness rather than destruction. JP says, if we're looking at are we looking at a serious correction? All the signals are there. Well, the thing is, I think, a lot of these things happen at once. We've got the debt ceiling in the US, we've got the UK inflation being sticky. So, often these things kind of coincide, and then you get a kind of combination of the two driving markets down. But it's certainly not looking good for the UK and for risky assets generally. Does this mean that the Tory government can finally stop blaming the war in Ukraine for inflation? It's not just them, remember, it's also the Bank of England, and admit that Brexit has been a disaster. I mean, it certainly hasn't been good for growth. A lot of the warnings that people had before Brexit haven't come true. But if you look at some of the components of inflation, food imports, for example, are a big part of it. And of course, we do import a lot of food. And if you restrict the workforce, which is effectively what we've done, that's inflationary, because if you train people locally to do the same jobs, they'll probably demand a higher wage than someone from Eastern Europe, say. So, no question, it's kind of inflationary. Have you seen much inflation in the price of dog food? Yes. So I've just ordered Teddy's food for about a month, and it cost about 90 quid, because he has to have special stuff, because he has an upset tummy often. So yeah, he had to have a special diet, and it's really expensive. So 90 quid a shot, but we do get 12 kilogram bags for him. Somebody's saying retire in Portugal. A lot of the clients I've spoken to recently have been moving to Portugal, to Lisbon and Porto, and they all say it's a lovely place, how beautiful the architecture is, the food's great, the people are lovely, so maybe that's the place to go. Yeah. Okay, well look, let's finish it there. It's been almost an hour, and thank you for joining us. Don't forget, we do have a live stream next week. If you do enjoy our videos and our live streams, then why not join our community? Because then you could interact with us anytime you like via our chat application, and also you get lots of members only videos if you join us. So to learn more about that, just go to PensionCraft.com. And let's hope that the debt ceiling doesn't actually get breached, and the US doesn't default on its debt. That would be catastrophic. I wouldn't worry too much about this inflation print. It's bad, but it's not catastrophic. But anyway, good luck with your portfolios, and join us next week if you have more questions. And thank you for joining us. Take care, everyone.